Had a question come in from a viewer yesterday, which I'm going to address this morning on this video. The question comes in from Big O, and you might remember I did a video a week or two ago because Big O sent in his very first trade, how he'd never traded before, put on his first options trade, made 270 bucks. So if you haven't seen that video, have a look at that. But yesterday, Big O asked this question. Hi Brent, I was poking around on the ComSec platform and found the multi-leg order section, which is this here. So in most of my previous videos, I only do a single options contract in the options order page. Big O said he was poking around, he found the multi-leg order and he wants to know what it is. So let's have a chat about that. He says, I found the multi-leg order section and I was wondering if you can explain this, or even give an example please. How does it work and have you done it yourself? And the quick answer to this is, have I done it myself? Yes, plenty of times I've traded multi-leg strategies. Do I use the multi-leg trading section of ComSec? Very rarely. So the quick answer is this. When you're trading options, you can either do a single leg trade or you can do a multi-leg trade. In most of my previous videos, I'm generally doing a single leg. Even though I may trade multiple options, it's still the same leg. It's just one options trade. In other words, I may have some BHP shares. I want to sell some covered calls over them, giving someone the right to buy my BHP shares from me. And in actual fact, I've just done this trade this morning, where I looked at my BHP shares. They're currently trading at close to $43. Well, they were trading at 43. They're now $42.93. It's currently 12:05, which is 10:05 a.m. here in WA. Just having my morning coffee, and I've put on a trade or two. I looked at BHP. BHP are paying dividends in 2 days' time. Today's the 2nd of September, and on the 4th of September, BHP is going ex-div. Meaning, if I own BHP today, which I do, and I'm still holding them, I'm going to be entitled to get 92 cents per BHP share that I own. And at the moment, I've got 424 of them. So 424 times 92 cents, $390. So I'm going to get a $390 dividend for my 424 BHP shares, which is going to be paid to me on the 25th of September. So knowing that, my expectation, again, not trading advice, I'm just telling you exactly what I did and why I did this trade and what my thought process behind it was. BHP is going to be ex-div in 2 days, meaning it will be trading without the ability to earn a dividend. Well, you'll still earn a dividend, but not till next year now. So, with 92 cents taken out of the BHP share price, because the share has to be worth less, right? If the dividend's already been paid, it's not as enticing to buy and hold BHP if you're a dividend trader. The dividend's been paid, it's gone. You've now got to wait till March next year. So, if you don't own BHP in 2 days' time, you're not entitled to get the dividend. Therefore, the price of BHP is probably going to fall by about this 92 cents or thereabouts. So when I look at the chart of BHP, I'm like, yeah, okay, so it's about $43 or thereabouts. Is somebody going to buy BHP in the next week or 2, 3 weeks for around $43 if the price has fallen down to $42? Probably not. So I'm like, okay, I'll sell some $43 or roughly options and collect some premium. So I jumped over to the derivatives. These ones expire on the 4th of September, which is literally in 2 days' time. So of course, the $43 call option, or in this case 43 and 1 cent, because I generally like to sell the European style option rather than the American style, it's only 10 cents. There's not enough money in it for me. 10 cents times 400 BHP shares, it's like 40 bucks. After a brokerage, I'll walk away with $2 or something. It's not worth it. So I jumped down to the 18th of September, which obviously is in, about 2 weeks' time. And the $43 and 1 cent, they're trading between 30 and 40 cents. So I'm like, yeah, okay, I'll sell some of those. So again, 43 and 1 cent is a European style option. So I was going to sell to open 4 of, and I'll put my offer in at 40 cents. And that's actually still sitting in the market. That's mine there, 40 cents. which is obviously 40 times 4 is 4 4s 160. Less brokerage, I'm going to collect $25 or thereabouts. So the bid and offer, that's my offer there at 40 cents. Still sitting in the market. Bearing in mind, when I placed this trade half an hour or so ago, BHP was trading at $43. Now it's dropped down slightly, but that's okay. I'll let this sit in here. So when I look at my orders, you can see here's mine still as an outstanding order sitting in the market. I'm looking for 40 cents for 4 of them. That was placed at 11.28 or 9.28, 9:30 this morning, which was about 45 minutes ago or so. Yeah, 45 minutes is my confirmation email that I got 45 minutes ago. So, getting back to Big O's question about the multi-leg and why I'm telling you about this trade. This trade is just a single leg trade. This is bread and butter stuff. I do this a lot. When you're talking about multi-leg trades, we're talking about bull call spreads, bear call spreads, bull put spreads, bear put spreads, butterflies, vertical spreads, iron condors, calendar spreads, ratio spreads, all those sorts of things. More advanced stuff than what I'm generally covering in these introduction videos. And I'm not going to get into those sorts of trades here in this video because I want to try and keep it quick. But essentially, a multi-leg spread is where you are buying and selling 2 or more option series in the same trade. So to give you an example, the trade that I've just explained here is a covered call. Very simple. I own the shares, the BHP shares, 400 of them, or 424. I sell some calls over them, which is what I'm trying to do here. It's a covered call because it's covered. I own the shares. I'm giving somebody the right to buy the shares that I already own. It's covered. Now, if I didn't own the shares, I could do a more advanced strategy where it's like I will sell the call options, but it's naked because I don't own the stock. But at the same time, I will also buy some call options, giving me the right to buy BHP off somebody. So in other words, let's just say BHP is trading at $43. I give you the right to buy BHP off me for $43 on or before September the 18th or something. Well, that's all well and good. So again, let's have a look. Here's BHP. Let's imagine I didn't own BHP shares at all, but I want to sell the right to you to buy BHP from me. Now I might go out to, again, the 18th of September and say, okay, here's the call options on the left. I'm going to give you the right to buy BHP from me on or before, if it's an American style option, on or before, or if it's a European option, only on the 18th of September for $43.01. This is the option I'm selling at the moment, trying to, for 40 cents. So if on the 18th of September, BHP is trading for $45, well, of course you're going to buy them off me for $43 or $43.01 because it's $2 cheaper than what they're trading on the market. Now, as a covered call, it's not a problem to me. I'm giving up the potential profit of that extra $2 because I took the 40 cents now, today, at the start of September. But if I didn't own BHP, then I have to go out and buy them to deliver them to you. So in other words, you give me $43 times 100 or times 400. To keep it simple, let's just make it 100. You give me $4,300, but I've got to go out and spend $4,500 to buy the BHP shares so that I can deliver them to you. So I'm $200 out of pocket. $43, $45, $200. But yes, I took $40 now, so I'm literally at $160 out of pocket. So if I wasn't doing a covered call strategy, I could do a multi-leg strategy, like a bull call spread, or a bear call spread, or a bull put spread, or a bear put spread. So again, without going into too much detail about it today, a bull call spread is a debit spread. A bear call spread is a credit spread. Here's how it would look. I would say, hey, I'm going to sell you the 43.01 call option, and I want 40 cents for it. But at the same time, if it's a bull call spread, I am going to buy a 42.50 call option. So in other words, you have the right to buy BHP off me for $43, or $43.01 in this case, but at the same time, I have the right to be able to buy it off somebody else for $42.50. Does that make sense? So you come to me and say, hey, I want those BHP shares off you for $43. I'm like, okay, no worries. I go knocking on this guy's door. Hey, remember me? You sold me the right to buy your BHP shares for $42.50. I paid you 70 cents for it back in the day. Can you see how that would work? So have a look at this. $42.50. Let's just say I had to pay the top dollar for this. In this case, it's 73 cents. Let's round it down. Let's imagine that right now I can buy the right to buy BHP for $42.50 on or before September the 18th. I can buy BHP for $42.50, but right now it costs me 73 cents to do it. Let's round it down. Let's say it's 70 cents. Okay, so it's cost me 70 cents to buy these options. At the same time, I'm giving you the right to buy BHP off me for $43.01, and you're going to give me 40 cents for that right now. That means this trade's cost me 30 cents. It's a debit trade. It's not money in my pocket, it's money out of my pocket. It's cost me 30 cents, the difference between what I collect, the 40 cents, and what I pay, the 70 cents. But what it means is, when you come knocking on my door saying, hey, here's $43, give me 100 BHP shares, I knock on this guy's door. This is all metaphorically speaking, of course. I'm not knocking on anybody's door. This is all done on the brokerage platform. But I knock on this guy's door and say, hey, how about giving me those 100 BHP shares for $42.50? But you've given me $43, I'm giving this guy $42.50. So I keep the $50. So while it's a debit trade now, because it's costing me 30 cents times 100, which is $30, if the trade is exercised, or I'm assigned, I get to pocket $50, the difference between the $42.50 and the $43, which is $50. It cost me $30 now, today, but I get to collect $50, so I'm $20 ahead per 100 contracts. But this is a debit spread, and I'm relying on BHP being above $43. Otherwise, both options expire worthless. Or more correctly, it needs to be above $42.50. Because even if it's $42.70, I'm not being exercised on the $43 option. Nobody's coming saying, hey, give me your BHP shares for $43 if you can buy them for $42.70. But if they're $42.70 and I can buy them for $42.50, I'm still in front on this option leg. Does that sort of make sense? So that's a debit spread, and the name for that particular trade is a bull call spread. Now, a bear call spread, slightly different. It's a credit spread, where it's like, okay, I'll give you the right to buy BHP off me for $43. You give me 40 cents for it, but then I'll go and buy the right to buy BHP off someone else for, say, $44. And for that, I might pay 10.5, 17.5, let's say 15 cents. So I collect 40 cents from you and I spend 15 of that. That's 25 cent credit to me because you've just given me 40 cents and I've only had to spend 15. But what that gives me is the right to be able to buy BHP off someone for $44. So while I take the credit now, today, I run the risk of still taking a loss if I'm exercised. So I'd only do this if I expected BHP was going to fall below $43, because I don't want to be exercised on a bear call spread. Because I'm saying to you, hey, come knocking on my door in a month's time, or in this case 2 weeks' time, with your $43 and I'll give you 100 BHP shares. Well, that's great, but then I have to go and buy them in the market. I am protected because unlike a naked trade where it's like, I don't own the BHP shares, I've got to go and buy them. They could be 45, 47, they could be $50. Well, the most I would stand to lose on this trade is $1 because you're buying them off me for $43. I'm buying them for $44. So even if they go up to $50, I'm still able to buy them for $44. But don't forget, I've already received 15 cents, 40 cents. I've already received 25 cents credit today. So take that out of the dollar is 75 cents. So the most I would stand to lose on this trade would be the dollar, the 43 to the 44, less the 25 cents that I've already received today in credit. The most I stand to lose on this bear call spread is 75 cents. So in answer to Big O's question, and again, there are many, many different multi-leg option trading strategies. I've just talked briefly about two of them, the bear call spread and the bull call spread. Now, let's just imagine we were going to put this bear call spread on. This is the one where it's a credit spread, where it's like, hey, I will sell you the $43 call option, giving you the right to buy BHP off me for $43. So let's write this down. This is BHP TA9. And that's trading between 32.5 to 45.5 cents. Okay. And then the 44 is BHP TC9. And that's trading between about 10.5 to 17.5 cents. So when I say I want to buy and sell options, normally, in this case here, this is the 44. So remember, I want to buy the 44 and sell the 43. Now I could do this individually where I say, okay, yeah, give me 4 of these. And they're trading at, oh, you know, what did I say I want to spend on that? Oh, about 15 cents. Okay, well, after that's 60 bucks, after brokerage, it's about $95, blah, blah, blah. And then I could go through, this is buying the 44. I could also go through and sell the 43 separately, or I could do it as a multi-leg trade right now. Let's have a look. So multi-leg, and I say I want to buy BHP TC9, add to order. Okay, so that is the $44 call that expires on the 18th of September. This is the one we've been talking extensively about. That's trading for about 11 to 19. Now, it doesn't give me the option to put in here what I want to pay for it, but I want to buy them and I want to buy 4 of them. Okay, now I also want to sell the TA9, add to order. So the TA9 is the $43 call option. And I want to sell those. Remember, I'm giving you the right to buy BHP off me for $43. Therefore, I'm selling that option. So I'm selling to open. This one I'm buying to open. Now, this one here I also want to sell 4 of. Now, if you remember, I said the difference between the two, I should end up with about 25 cents of credit because a bear call spread is a credit spread. You can see here that it's telling me exactly that they reckon, they being CommSec, they should be able to get me somewhere between about 15 cents for the contract, for the difference, to somewhere as good as maybe 37.5 cents. Somewhere in the middle is about 26.5. So while I'm not doing the trade as 2 individual option trades, the outcome is the same. I want to buy the 44 call option, and at the same time I want to sell the 43 call option. If I was doing this individually, I'd say, yeah, look, I'll give you 15 cents for this one, not 19, but better than 11. And this one here would be like, yeah, I don't expect you're going to give me 48.5, but I'm not taking 34.5, I'll take somewhere. So that's exactly what this is doing. The bottom line is, if I was doing these 2 trades individually, I'd probably put an offer in here at about 15. And as you remember from the previous example when I was explaining it, I'd say, yeah, we'd probably get about 40 cents for this. Not 34.5, but also not 48.5, so about 40. 40 minus the 15 is 25 cents. So we would walk away with about 25 cents. Times 100 is $25, times 400 is $100. That's what they're saying. Now I could actually put in a limit and say, I want to receive, not pay, because it's not a debit spread. A bull call spread is a debit spread, but this is a bear call spread, which is a credit spread. I want to receive 25 cents. The problem with this is obviously you're paying brokerage twice. Now, it doesn't matter if you do these as 2 individual trades or if you do them as a multi-leg trade, you're still paying the same amount of brokerage. Here, 2 times 35, whatever it is, you know, 70 bucks. So if I'm getting 25 cents times 4 contracts, that's $100. There it is there. I'm receiving $100, but it's costing me 70 bucks to do the trade. So I'm walking away with 28 bucks or something. It's not worth it unless I was doing larger quantities. So instead of doing 4 contracts, I was doing 10. So then I'm pocketing $250 less brokerage. It's $177. But then my exposure is greater, right? Because what am I doing in this trade? I'm saying, hey, you can buy BHP off me for 43 bucks. Great. You can buy 10 of them. Wow. Okay, great. Well, that's $43,000. But then I also have the right to buy BHP for $44 times 10 times 100, which is 1,000. So 44 grand. So in other words, you come to me with $43,000, say, hey, give me those 10, 100, so the 1,000 BHP shares. Here's 43 grand. Well, that's all well and good. I then need to come up with 44 grand to go and buy them for $44. So I'm $1,000 out of pocket, less the 177 that I've just collected now, is about 823 bucks out of pocket. So my risk to reward on this trade is about 4.5 times, because, you know, $177 times 4.5 is, you know, 800 odd bucks. Again, more advanced stuff, but I hope this answers your question, Big O. This is what a multi-leg order looks like on CommSec. And this is using just 2 legs. This is a bare call spread. There are some option trades where you may do 4, 6 or 8 legs. Like iron condors, butterflies, those sorts of things. Iron condors use like 4 legs per trade. And again, more advanced stuff that I'm not going to cover in this video. But essentially, an iron condor is like doing a bare call spread and a bare put spread combined. Or a bull call spread and a bull put spread combined. Where it's like saying, okay, BHP is currently trading for 43 bucks. I'll give you the right to buy it off me for 43. I'll buy the right to buy it for 44. But at the same time, I'll also give somebody the right to put it to me for 43. But I'll also buy the right to put it to somebody else for 44. And you're doing all 4 trades at the same time, or all 4 legs at the same time. And this is what I love about trading options. You have so many choices depending on your view of the market. So if you look at a stock price like BHP and you say, oh look, I think that this stock's going to continue going along, you know, bouncing between $43 and $40 or thereabouts for the next 3 months, well then fine. An iron condor might be a great trade. It's a credit trade where you say, look, I don't think BHP is going to finish above $44, therefore I will sell some calls, but I'll also buy some calls higher than that just to protect myself in case it does. But I also don't think it's going to fall below $40, therefore I will sell some puts. But just in case something crazy happens, I'll also buy some puts. That's an iron condor. Selling call options and buying call options above it. Selling put options, but buying put options below it. Simultaneously. That's an iron condor trade. So, hope that's made sense to you, Big O, and others. That's what a multi-leg trade is. Well, not so much what it is, but how it's traded. And in answer to your original question, what is the multi-leg section? And can I give an example? That's what that is. Hope that makes sense. Oh, and as a quick update, in case you're wondering, did my trade go through? Remember, I was trying to sell 4 BHP call options, European options, with a $43.01 strike price, expiring the 18th of September, and I was sitting in the queue, waiting to get 40 cents per contract. Yes, they did. While I've been putting this video together, I just checked my emails, and at 11:18 AM, I got the notification. We've sold for you 4 contracts of the 43.01 call option expiring 18th of September for 40 cents each. 4 4 is $160, less $35 brokerage and costs. Net proceeds $124.48. Cha-ching. So that trade's gone through. Let me know if you have any other comments, questions, concerns. Subscribe if you haven't already. Thanks for watching, and I'll see you in the next one.